Thank you all for joining us today for today's webinar. A really timely subject as we look at the potential for recovery and the strategies for positioning clients best to participate in what may be to come. As Megan said, I am with Natixis Investment Managers, where I'm the head of the Center for Investor Insight, which is a global research program aimed at understanding the sentiment and behaviors of investors around the world. And we'd like to thank the Council for inviting us to be part of this session. Joining me today is Jack Janasiewicz, Portfolio Manager at Natixis Advisors, here to share his views on helping clients navigate the recovery. Jack, thanks for joining us.
Thanks, Dave, and again, thanks to the Active Managers Council for the invitation to chat with everybody today.
Well, for those not familiar with Natixis Investment Managers, we're a global multi-affiliate investment firm. We have more than $1 trillion in assets under management, and we rank among the world's largest asset managers. Our firm brings together a diverse range of investment affiliates through a single point of access, and that includes firms like Loomis Sayles, Harris Associates, who manages the Oakmark funds, and the international and emerging market specialists at WCM. It's having this structure that allows us to deliver a diverse range of solutions across asset classes, styles, and vehicles, and support you in growing your business. The Active Managers Council is an organization formed by the Investment Advisors Association to provide education and research on the value of active management, both for investors and as well as its role in the capital markets, and also to engage on key public policy issues. Since its formation in 2017, the Council has produced a wide range of papers, underwritten academic research, and curates educational content on active management, all of which is available at activemanagers.com. So I encourage you to take a look at that. There's a lot of great information, a lot of useful ideas to find there. Perhaps what's most relevant to today's discussion is the Council's paper, A More Balanced Narrative. It takes a critical look at all the arguments against the viability of active management and offers insight on how active management can add value in today's markets. And that's where we'll start, today's markets. You think about it, vaccines may have been the best news investors have heard in a long while. But those who ignore the need for an active strategy in managing their way through the recovery may really be stuck without an effective plan. Now may be the time that advisors can best have these conversations with clients about where active management fits into their plans and how it can help them achieve their objectives. Jack, let's jump in. And one of the things I was thinking about, Jack, is we did a survey of fund selectors, so the people who manage the platforms at RIAs, wirehouses, all the distributors around North America. And when we talked to them at the end of last year, they said volatility and inflation are their top risk concerns for this year. And it was interesting, they projected volatility not just for stocks, but for bonds as well. And when they looked at a range of factors that were coming to bear in this, 8 and 10 told us that this is a market that's going to favor active management. So if people are anticipating that vaccines are the first step into recovery and the market's poised for this big rally, what's the rationale for active management at this time, Jack? What are your thoughts?
So I like to think about market rallies in defining them sort of in mini cycles. And typically the market rallies in what I call 3 different ones. The first one being what I call just get me in, sort of everybody piles in as fast as they can. Usually the go-go high beta names are the ones that a lot of people want to grab when they sort of are trying to just get exposure to the market. Once that phase sort of plays its way through, then you go into the laggards phase where the laggards then start to play catch up. So people are looking to see what's underperformed by those so they can catch up. And then the last portion of that, it's relative value, right? With the dust sort of settles in, you start looking around and see where value might be in the marketplace. And that's where that differentiation kicks in. And so we put that in the context of what we just went through, right? You came off the pandemic lows back in mid-March. That was sort of the just get me in phase. And that sort of is characterized by the stay at home names, right? Think about all the things you could do at home, the Amazons, the Netflix, Googles, the Apples, those sort of names. But as we got towards the end of the year, he really shifted gears, and then I would say that's the laggards switch that came in, and that's really when the Pfizer news hit on the vaccine front. So if you think about the reopen names, those being things like the airlines, the hotels, the travel industry, they started to pick up. So those at that point, those are the laggards. So we shifted from stay home to laggards, and I would say now we're somewhat in between some of this, but you're getting into that relative value portion of the marketplace. And that's where I think you start to see these differentiations that pick up, right? You've got segments of the markets that are working, some better than others. If you're inactive, hopefully you're now starting to see rotations into some of these places, taking advantage of these these little different mini cycles. And one other thing to point out that I think is very interesting, if we sort of look at what's happened since the beginning of the year, we've had these rolling corrections that I like to call them, right? Beginning of the year, it was tech, and because tech by nature is a big chunk of growth corrected, energy corrected by over 10%. Then we just had small caps as we came in through the end of March. If you're just sitting in passive, you're going to ride through all these sort of ups and downs and not take advantage of some of these 10% dislocations that we've seen. And so if you sort of look at where we are today, those market cap weighted indices that are dominated in the passive space, just because you're market cap weighted, those stay home names are the biggest beneficiaries. That's what you're now overweight. And that's probably the part of the market that you probably don't want to be in right now. As the vaccines kick in, the reopen names are starting to win, herd immunity is now becoming an issue. Do you want to stay home on a Friday night and download Netflix movies, or do you want to go to Six Flags? You know, are you going to stay on a Thursday night and shop on Amazon, or are you actually going to go out to the mall and get out and do something? Are you going to watch a movie, or maybe get on a plane and fly to Hawaii for your vacation? That's sort of the things we're talking about. And you're not taking advantage of these shifts in the market by just sitting in passive. That's why I think active matters.
So it's really interesting you mentioned that kind of pent up demand, the opportunity that's getting opened up for a lot of people. And it's funny, when we spoke to those fund selectors, you know, at the end of last year, they're thinking ahead, much like you're talking about the laggard kind of rally. And what they were telling us is they're expecting active to outperform passive. And they were actually telling us they're planning to add more active strategies to their platforms overall. So they've got that in mind. But one of the things they're worried about, they tell us, is that they think that individuals are not going to be positioned well to take advantage of these opportunities. Here's a fact I just think is really interesting. 9 out of 10 of those we surveyed in that particular study say that low rates, they've distorted values, and they believe that current valuations don't reflect the fundamentals. And this is the important part. You know, almost the same number around the world say retail investors simply are ignoring fundamentals. And I think back to the discussions we've had over time, right? Low rates has been this rising tide that's lifted all boats. And I guess the question becomes, do fundamentals matter anymore? Is that really important to the investor now?
Yeah, that's a great question, and I'm going to answer this by, it's sort of the wishy-washy answer. Yes, they matter, and no, they don't matter. I mean, when I say no, they don't, there's plenty of other things that I think can overwhelm the market, and that's the liquidity backdrop and the technical backdrop, and you can sort of position that through the view and the lens of valuations, right? Fundamentals can only go so far, and we hear a lot of those same complaints manifesting in the valuation argument, right? My current opinion on valuations, I call them an opinion, and you don't really know how to handicap my opinion, right? You don't know how to handicap the price that I'm willing to pay for something I want to own. And as a result, you can see some of these valuations really overshoot. And so looking back at historicals, that might not matter. I think the bigger issue, and it's not really fundamentals and it's not necessarily technical, it's a combination of the two, but what matters most is really risk appetite. And risk appetite's a function of your expected returns. And one of the great examples I like to give, think about the mid-2000s, the Greenspan conundrum, right? Rates went from 1% all the way up to 5.25%. So the Fed hiked 425 basis points during that time. What did stocks do? They want to tear. And that's all because risk appetite was so strong that the incremental change in rates, for example, it didn't matter. And that's sort of the same backdrop that we're talking about here. Fundamentals can be overwhelmed by a lot of things that are going on in the market that may seem dislocated, but you just don't have any idea how to think about those things. And I'll give you a couple examples on the back of that, right? Yeah. Think about demographics, right? Aging population. Well, those people are going to be shifting from equities to bonds later in their life. That's just more incremental demand for fixed income. That could easily cause an overshoot. Currently, we're seeing millennials coming into that sweet spot of the marketplace, right? They're starting to make money, starting to get into household formation. That means they're going to be saving more, they're going to be investing more, they're going to be buying houses. That's a huge demographic bulge that could easily overwhelm fundamentals. Think about asset liability matchers, the insurance pension fund side of the equation. You know, these guys are growing at leaps and bounds. They have to own fixed income. That continues to put a constant bid into the market. So, you know, to summarize all of this, I think a lot of these things can overshift. Fundamentals may be less important than most people think. I always say, don't be a hero and try to fight some of this stuff. Go along for the ride on a lot of this. That's the big backdrop that I continue to argue about. And, some of these concerns that you're talking about actually might be a good thing because it keeps risk in check. So bottom line, fundamentals might matter less than most people think. How about that?
An excellent answer on that, because it also opens the door to another thing that we're seeing with investors in our own surveys. And we've talked about this a number of times. And this mismatch that individuals have between what they want for returns and what they're willing to take for risk, right? And the last time we asked, which was 2019, the return expectations were 10.9% above inflation. So real returns at 13%, 14%. And that's really 60% higher than what most advisors say is real. So this huge expectations gap. And the other thing that I find interesting, that was a 1-year return. Over the long term, they're expecting 11.3% above inflation. So they think it's never going to equal out. And what's important, though, that same survey, when we ask individuals, what do you prefer? Would you like to have performance or safety in your investments? And it's 8 out of 10 telling us they want safety. So they can't rationalize this. We talk about it becoming risk on. Talk a little bit about how, when investors want to have their cake and eat it too, what does it tell you about the need for active strategies when you're investing in recovery? Because that potential is great for that disconnect.
That stat actually, we had this discussion a couple of days ago. When you brought that up, Dave, that stat blew me away. And I did a little digging on the back of this. So, when they're talking about 10.9% above inflation, wow, I hope that happens, really, even from my standpoint, from a portfolio manager standpoint. That'd be fabulous. I'd be thrilled with that. But what's interesting, if you go back to 1926, that's the average annual return for the S&P 500. So going all the way back to 1926, and again, coming out of 1926, the S&P 500 really isn't how we think about it today. And so then if you shrink that time horizon down, so since 1957, and that's when the S&P went to 500 stocks, it went from about 90 to 500. That number drops down to about 8%. So at least I have an understanding where the 10.9 comes from. That's the historical average. And I think a lot of that's very front-weighted, so to speak. But return expectations need to be recalibrated. That's certainly for sure. And the one thing that I find interesting, a lot of people think about those total returns. You need to think about it in a portfolio context, right? The average investor is going to probably hold something close to a 60-40. And so if you're trying to tell me you're going to hit something close to a 10% return, let's do some math. Let's work backwards here, right? The bar cap ag right now yields close to 1.5, give or take. If I assume 40% of my portfolio is going to be basically targeting that gives me on average a 62 basis point return. Yields do a pretty good job of being a forward return estimator. That means that the 60%, in order for you to hit that 10% target, you need to get a 17% return on your equity sleeve. So on a 60-40, equities need to give you 17% to offset the bond portion to get to that 10% level. Now think about that, right? That's a significant bump up. Now you're talking at people close to retirement age. Do you really want to have that sort of bent in your portfolio? No, again, it's a little bit of a hyperbole, but you get the point here. These are really, I think, above average expectations that need to get sort of massaged back down. And a couple other things to think about in the back of this, right? And we've talked about this a little bit already, but there are some headwinds, right? Markets tend to go up longer term, so you're going to have a structurally bullish bias. But within this, you're going to have secular trends. Right now, it's secular growth coming out of tech, cyclical growth, the more shorter term ones, small caps, cyclicals, internationals. These all ebb and flow. If you really are going to try to hit that sort of a return target, you need to be proactive in making sure you're moving in these pockets of those short-term cyclical and secular trends that are in the market. And one thing to hammer home that point, think about it. The S&P year to date is up 11.9%. Energy's up 34%. It's 2% of the S&P 500. 2%, 34%. That's not going to get you anywhere. It's too small. High beta within the market, up 29%. FANG, the large cap techs, up 9%. So those dislocations, right? You're going to be overweight the S&P. You're going to be overweight those FANG names because it's market cap weighted. You're not going to hit those 10.9/17% targets you need. You're going to need to play these little segments within the marketplace as well, like energy, like high beta. That's where the active rotations start to come into play. And that's the differentiator, I think, of where you're going to start to see maybe some of these above average returns going forward.
So yeah, always an entertaining data point because it actually went up after it got volatile during that period there. It never goes down when you think it would. But the interesting part to me too, though, is this disconnect with the risk management. How important is the connection between active management and risk management in this? That idea of actively managing what's in the portfolio for opportunity. What's the flip side of that for having a conversation with clients?
Yeah, and I think this is also something that really is underappreciated because, you can add alpha in two different ways, right? You can add it to the upside and you can add it to the downside, right? Upside, above average returns, picking stocks, industries, sectors, right? But, on the other side, by adding alpha on the downside, you can de-risk the portfolio. And that I think is also very key and maybe gets sort of disregarded because it's not really sexy to outperform on the downside, right? Yeah, I'm making less, but I'm losing less, but that adds up after a while because of the compounding effect. But again, the passive side of the market here, you're at the mercy of the market. You're going to be going up and down as such. But if you have skillful managers on the active management side, think about it from an equity perspective, right? I can raise cash. I can rotate from cyclicals to defensive. I can own higher quality equities, maybe cash flow rich companies, low PE companies, low beta companies. On the bond side, I could shorten duration. I could move up and down the quality spectrum ladder. So I can manage those risks. So when you get some of these longer term structural downshifts, which we get every 7 years, you can actually manage some of that downside risk to protect. So you're starting on that higher base when you start to compounding it. So again, passive, it's set it and forget it. Buckle up. You're going to be riding with the markets. Whereas at least when you're with active, there's risk management that comes into play, and that can start to benefit, especially longer term when you think about the compounding effects.
All right, so you raise a really important point. If the opposite of active, on the passive side, we see this conflict about risk and return really playing out in the views that investors have on passive investing. I think of it in terms of passive has gotten so much good press in the past 10 years that investors are making a lot of wrong assumptions about things. They're not thinking about what these investments can and what they cannot do. For example, investors in our survey told us that index funds were less risky and that they were going to protect them on the downside. And I presented that data to advisors in 2 or 3 different settings, and always that kind of smile and that kind of look up of like, yeah, this is what we're dealing with. So my question is, what do advisors need to be aware of it, and how do you really set that record straight and reset their expectations around what indexing does?
Yeah, I think maybe the easiest way to think about this, first of all, your first comment there, Pastor's done a great job marketing, no doubt about that. Yeah. So that creates a little bit of an uphill battle, obviously, because you're ingraining a lot of these comments that you've made into the investor psyche. But again, you sort of get what you pay for, right? And you hit it right on the head. Passive helps you access every opportunity in the market, right? It's good and bad. It's not good or bad. It's good and bad. So the concept that you're buying into the rising tide lifts all boats thesis here, but I would highlight the idea that some of these boats might be carrying some dead weight and potentially an albatross, right? Maybe you're aboard the SS Minnow on some of this stuff. Point being, though, you're buying good and bad. It's not good or bad, and that's very important here. And something I think that's worth stressing, again, a lot of these ETFs are going to be, or passive funds are going to be market cap weighted, which turns you ultimately into a momentum play, right? As the market goes up, those ones that are outperforming grab greater market share of those indices. Effectively, you're a momentum player. You're a momentum investor. And momentum investing is, it certainly has some merits to it, but momentum doesn't continue in perpetuity, right? It's going to correct. Right. And so at some point, you're no longer going to want to own those names. And again, go back to what we just talked about, stay at home, reopen. Stay at home names, large cap tech. What happened there? They became a big portion of the overall market. People now consider large cap tech to sort of be a long duration asset, right? Assets that rely on significant growth for well off into the future for those cash flows. As rates push higher, like we're starting to see, those, again, future cash flows come into question for 2 different reasons, right? Discounted cash flows, when you bring it back to net present value, the value of the company, that's going to hurt from a discount rate perspective, but higher rates are going to crimp overall growth in the future as well. So you're starting to see those large cap tech names come under a little pressure as rates rise. Again, they were the big beneficiaries. They were the momentum plays. What happened? They become a bigger portion of those passive markets. So the question here is, do you really want to be long large cap tech in here? Maybe, maybe not. But the point is, if you're just along for the ride, that's sort of what you're getting. and you might be missing out on some other opportunity. And here, as I mentioned before, FANG's actually underperforming the S&P right now.
So when we were talking about this the other day, you had a really interesting point in the advisors that you talked to. You talked to a lot of advisors around the country, and you get the sense that their role is a little bit of being a therapist and working clients through these things. And we've actually written about that and find a lot of advisors agree with that. Half of their job is really explaining and communicating, helping investors, their clients really understand it better. What does that conversation sound like? You've got someone who's keyed up around an index fund. They maybe are getting the picture that this is the best way to go because they've read the press. They may not understand them fully. How do you start talking them into this is why we need active at this time?
Yeah, and it's funny. I think you're spot on with this comment as well. A lot of advisors tend to have to be shrinks per se. The idea is really to try to keep your clients invested in the market as opposed to being out of the market, and that's half the battle, right? And a lot of the conversations that I'm having with clients, I'm hearing all the bear cases that are in the world, and it's sort of like the market goes up 70% of the time. I want to start with a bullish bias, and then we'll move to a bearish bias when the facts change. So that mentality sometimes can be challenging. But to your point, how do we sort of get over that hump? And I think it's sort of just know what you're getting into, right? Know, yeah, sure, if you're going the passive route, you're probably going to get low fees and you're going to get easy access to the market. That's sort of the rallying cry that we hear with a lot of the advertising on the back of this. But think about it from a mathematical perspective, right? If you're in a passive product, you're paying a fee, and you're going to have slippage from transaction costs as well as just the friction involved with running it. So inherently, you are already going to be underperforming the market. So if your objective to set out is to outperform the market, you mathematically can't do that, right? Just because of those numbers. With active, at least you're getting the opportunity to better the market. So that's one of the key things there. Know what you're getting into. And the other big one that I think, again, we touched on earlier, is underappreciated. It's the risk management component of all this. And you don't really get that in terms of passive management when you're thinking about active versus passive. And that's a big one, I think, as well. So the idea that active, you're getting their best ideas, you're moving timely in and out of sectors that are cyclical and structural. We talked about that earlier. Those are very important. So to kind of take it all home here, you want the ability to beat the benchmark, active. 100% chance you can't do that with passive. You want to look different than the bench. That's why you're hiring a specific portfolio manager for skills. You're definitely not getting that in passive. You're concerned about volatility. Passive, set it and forget it. You're along with the ride. You're going to do whatever the market does. And again, that downside protection, that risk protection we talked about, at least you're going to get some of that with active management. So I think it's sort of know what you're getting into, understand what you're getting into, make sure you know what you're looking at.
Well, and I think that's one of the challenges we're seeing with the attitudes that we get in our surveys, right? One of the things I think about is that basic premise of an index fund is that it's market exposure at a lower fee. We know everyone's hypersensitive around fees these days, but what we're seeing in our data is that's not even mattering anymore, because you're seeing about 3/4 of investors say, okay, I get market returns from index funds. Only 53% are telling us they get it at a lower fee. So there's a huge drop off in that. That means I think a lot of that message has been eroded. A lot of overconfidence in what it can do. We saw that everyone thinks that there's better risk management in it, that it's going to protect them on the downside. And what we do know is, even though they're thinking this way, we see that investors, like 9 out of 10, say fees are really important when it comes to selecting investments. So I'm wondering, are we getting into a case where we're now not having a conversation around cost, and we need to be having a conversation about value? And what does that create? And I would say, if we looked at active management, we see plenty of investment reasons to be there, right? It makes a lot of sense to it. Let's talk about it from a cost-benefit association with it. How do you talk to clients about why they're paying an active management fee, and where does it really make a difference to them on that?
Yeah, and it's, again, we've hit on a lot of these same points, right? It's going to be that sort of acumen, that investment acumen that you're picking a specific manager for. It's also going to be the risk metrics that are associated with portfolio management. And again, whether it be raising cash, whether it be moving into other sectors of the market that are either more defensive or maybe more bullish, depending on where we're at. But the idea is that you've got someone who's able to look at the market cycles, to actively move in and out of those areas that offer either upside or downside protection. or risk-adjusted bets. Basically, that's what we're looking at, right? Those are the two key takeaways to me. And it's sort of like, listen, you're going to pay for what you get. And if you just want to kind of ride along with the market, sure, that's what you can get. But if you want to try to smooth that out and have an opportunity to have a better ride and maybe get to that sort of that end game sooner, the only way you can do that is actually through active management. Bottom line.
Yeah. I think, and the final piece of that equation too, you just brought up this idea of volatility. And we know that investors really are averse to volatility. And I'm going to say we did research with MIT back in 2015, so six years ago, let's say. And one of the things we came to looking across the world is that there's this give and take between advisors and clients. And investors themselves came across, they're extrapolators. Whatever's going on in the market's going to continue to go on in the market. And then when you look at advisors, they're the exact opposite. When they look at the markets, they're the ones who are going to say, you know what, let's be contrarian here. Let's take a little money off the table. Let's kind of manage for the long term, all those pieces. But thinking in terms of that relationship and what happens when markets get volatile, what should managers be looking for when they're thinking about or what should advisors be thinking of in terms of how managers navigate volatility? What do you watch for if that's a concern? Because we know that it's a concern of the fund selectors.
Yeah, and again, this goes back to sort of being the market psychologist, right? The trick is to keep your clients invested in the market, or if it comes to one of these big moments where you have something like the global financial crisis, or like the COVID drawdown, where we saw a lot of the liquidity backdrop change in the marketplace and the fundamentals deteriorated rapidly. That backdrop, I think, is worth maybe that's where the active risk management really can take place. But we're not in the business of trying to worry ourselves about 5 and 10% corrections, right? The stats, we all know the stats, right? 5 to 10% correction is going to happen 3 times a year. You're going to get a 10% correction once a year. And I'm fine with that, because I know when I do my checklist, so to speak, that backdrop still looks supportive, right? It's when that checklist starts to change, then we start to think about the risk management perspective. That's where I start to consider things like volatility and that sort of backdrop. So again, it goes back to the idea of you're trying to keep your clients invested. You're trying to stay invested. 3 to 5% drawdowns, 10% drawdowns, that's going to come right back. The issue is going to be the bigger ones, which come every so often. That changes things a little bit. But the point here is simply, you're looking ahead. You're trying to stay invested. You're hopefully taking managers that you've done your due diligence on the active management side that prove that they can both manage upside risk and downside risk. And that's what you're hiring them for, bottom line. And that's what they're there for.
Yeah, I mean, to me, this is the challenge when we look at the market. Things are keying up to look very positive. Looks like we're going to see, kind of this rally it's almost built up, even though it's been rallying for a year. You feel like people are expecting more to come. And that idea of being able to participate in a meaningful way, being able to kind of navigate it in a way that you're not overexposed to risk, or you're not missing the opportunities on this. Thinking of that, and particularly your role as a portfolio manager, how do you think in terms of positioning when you're looking at the potential for something out there? The lead time might be as long as 6 months, it might be 8 months, it might be 2 months. How do you think in terms of positioning portfolios and anticipating that?
Yeah, and a lot of this has to do with patience, right? I always say that you can get the direction right, or you can get the timing right. Rarely do you get both right. If you do, you either got lucky or you're a liar. So pick your poison on that one. So, the bottom line with that is hopefully you're getting the direction right. The timing, you're probably going to be off on that. But it's all about patience, right? And if you're doing the due diligence on the back of this, you believe in your fundamental analysis, it's going to take some time for the market to come around to your viewpoint. Bottom line there is, stay with what your process is, and that process quite often does rely on patience. And again, it's not a sprint; it's a long-term play. You were trying to hit these goals, and I think some of that has to do with just framing out the investment horizon that you're talking about, and that's a combination of what are you trying to get to, and the patience to make sure you get there. Those combinations, I think, are really what this all comes down to. So, again, that's sort of how we think about things. It's timing, but it's the direction that matters more so, and then having the patience to stay with whatever it is you have on.
Yeah, for sure. I mean, patience is the word, and I think everyone's patience has been tested and proved strong over the past year.
And I would also, David, I also bring up the other thing that complicates this backdrop is, the media just blitzes us every day, 24 hours a day, 7 days a week
Yeah.
with information. And that makes this job very challenging because we have such a short attention span for a lot of this stuff. So, as I like to say, one of the best things that happened to me when I came to Natixis, I got thrown in the corner office with no TV and basically aside from everybody. So I didn't have that constant news flow attacking me where I could sit back and really look at those longer term fundamentals and that patience I was talking about. And I think I've actually become a better investor as a result of that.
Turning off the TV is the solution.
Exactly.
It's good advice for a lot of ways of getting better, right? Look, I'm looking at some questions coming in. I think there's a really good connection point here. This idea of how do you choose managers on this? What do you look for? This is a theme I'm seeing across a lot of investments, not just active passive, but you see it in terms of ESG, you see it in terms of whether I'm growth or value. What do you look for in an active manager? What's the thing that tells you this is someone I should pay attention to?
Yeah, and again, think about what your goals are in here. And typically, you're going the active route because you're expecting to outperform the index, right? And so, in order to do that, you have to look different than the index. And so, I think that difference between what the benchmark has and what your portfolio managers that you're looking to hire has relative to exposure, that's the big one. So that active management gap, I think, is very, very important in terms of getting to that sort of backdrop. So that's the number one thing I think that matters the most, or the active share within that portfolio manager, that selection process, active share.
Yeah, that's something we haven't heard enough of, I think, in terms of looking at managers and looking at just investments, what performs that way. And I think that gets back to that idea of getting what you pay for. Yep. And that's a great gauge. I think this is kind of the extent of the conversation that we wanted to have today. And, we're getting towards the end of this. I would encourage our attendees, please send us questions that you have. We have a few lined up here to answer your questions about this. Jack has a great view on a great number of things in the market and really understands the process of managing money. Use this as your opportunity for that. And please, just as Megan had said, use the chat feature and reach out to it. And with that, here's one I would talk about. So this is interesting, right? The performance of active management has been kind of mixed through the pandemic. What do you take away from the fact that it hasn't been a complete sweep over to one side or the other?
I think this is interesting only because of the dynamics that sort of played itself out as we sort of sold off and then came immediately right back, right? The original sell-off to me was really a function of concerns around the fundamentals, but that morphed into a liquidity issue, right? And you saw it really manifest on the fixed income side of the equation. You saw treasuries really, the safe haven asset, they started to sell off. And that I think is one of the big points here when you think about why this was very different and why the Fed stepped in and why it was such a big deal. Really, the waterfall effect was it morphed into a liquidity issue. That complicated things. Fundamentals went out the window at that point. The same side on the flip side, the turn, a lot of people are still sort of looking around and trying to make sure, is this over with? How are we going to deal with this? And that's when you start to appreciate the amount of backstopping that you saw, not only from the Fed and all their credit facilities, but also from Congress. But the problem that we ran into coming up on the other side, it was twofold, right? It was very, very specific. As I had mentioned, the stay-home names really started to outperform. And I think people didn't appreciate the composition of the market, right? The U.S. economy certainly feels like it's much more service-oriented, but when you look at the consistency of the marketplace and the stock market itself, it's much more tipped towards manufacturing. And that dislocation, I think, threw a lot of investors off. They didn't appreciate the fact that, yeah, maybe we're in lockdown. I can still order things online. I can still kind of go about my business. And a lot of these companies were able to adjust on the fly and still succeed, even though we were basically in this lockdown. And I think that caught a lot of people off guard, it caught the market off guard, because quite frankly, we've never seen anything like that. So I think that dislocation, so you had the liquidity issue on the downside, and then just a very different mentality coming out on the other side, that I think created a very, very different backdrop. It really made for a growth portion of the market in the stay-at-home portion of the market really make a significant outperformance relative to everybody else. I think that's active versus the marketplace. Very unique situation here. Very unique.
I was going to say it's like no market we've kind of seen before. The external pressures on it completely different.
Exactly.
Actually, you touched on something I would want to know too. Is so often when we talk about active management, we're thinking in terms of equities, right? You naturally go to that side. Can you talk a little bit about active and fixed, particularly knowing that folks are anticipating rate hikes in the next 9 months or so? What do you think is the important part there?
So I like to say, so I cut my teeth on the fixed income side of the world. I was an emerging market portfolio manager for the previous 20 years of my life. And so I like to say that the smart money resides in the fixed income world. The emotional money's in the equity space. So I'll throw that one out there. But, I think there's still a lot of opportunity in the fixed income space, largely because, there's so many different levers to pull. And you can do that in the international equity space as well. But, you're looking at, you can play up and down the credit spectrum. You can play fixed versus float. You can move around on the duration part of the curve. You can play the industries and sectors. Those go sort of the broad mandates. There's certainly plenty of places you can go to add incremental alpha in the portfolio. And when we construct a lot of what we're doing, I almost see, it's very difficult for me to hear someone make the case for fixed income that you want to go passive. I've yet to hear a convincing case on that one, because there's just so many levers to pull on the fixed income side. But that's where active, I think, really can with a good manager, you can certainly do better than the benchmark.
I totally understand that argument. There are more variables in place. I think you do have to be the kind of the thinker of investors on that side rather than the responders, as you were saying. Can we talk a little bit about interest rates, right? If we are anticipating rising rates, let's think. One of the things we know also from our surveys, individual investors do not understand interest rates, right? We know like rates go up, two things happen, right? We know that the present value of the bonds is going to go down and that the potential for income is going to go up. I'm going to tell you, we asked 8,000 investors around the world, 3% of people got both sides of that answer right. I mean, it's a challenge. And what I think is fascinating from that, though, too, is that's what everyone's hearing about, right? Every night on the news, every time you turn on the radio, you're talking about what's the Fed going to do, and it's such an important part of the economic conversation. What does it mean for advisors to explain that to clients, particularly if you're saying we're going to actively manage fixed, but that also has implications for equities as well?
Yeah, this is a tricky one because the bond math can get a little bit interesting. But if I sort of take a step back and think about the fundamental backdrop here, our personal view is that the market's overshooting in terms of its interest rate outlook. We continue to tell our investors that inflation is a very difficult thing to generate. And there are certainly a lot of different factors that are at play. This goes back to what we were talking about a little bit before. There's a lot more at play than just fundamentals. There's technicals, there's positioning in the marketplace. Some of these things are making, I think, a little bit of a challenge to the fixed income market. Think about things like, the United States, our bond at 1.7%. Look around the world, 1.7% is pretty attractive relative to everywhere else in the world. You don't have a lot of options there. So that, I think, is one thing to consider. We talked about the demographic backdrop, right? The global population is actually getting older outside of emerging markets. That means they're going to have to invest on the fixed income side. There's a ton of money that's coming in on the backside of that. So the idea that inflation is going to be coming, which again, we say it's very hard to generate, so we don't think we're going to get runaway inflation. Throw in a lot of the technical factors, and I just named a few in here. We still think rates are probably going to drift a little bit higher, but is it enough to ruin someone's 401k account, their retirement account? Absolutely not. We'll drift a little bit higher. That's a good thing because that means growth is coming back, but we still think we settle in right around 2% on treasuries. And keep in mind, that's treasuries, fixed income with the credit portion of the market. The economy is recovering, so credit spreads will continue to rally. So when you combine the risk-free rate and credit spreads, the risk-free rate might slip a little bit higher, but we certainly expect credit spreads to tighten. Is it enough to offset each other? Maybe, but the point being, we're not doom and gloom. We're not macro-geddon on the bond side with higher rates in here.
I mean, and that is of the moment, I think, in people's thinking, but equally so is the question around taxes, right? Especially after, hearing the discussion going on and how we're going to pay for everything that we've had to do through the pandemic and all the stuff that wants to get done. And part of that is higher capital gains taxes. And what I'm wondering there is, How does that play a role in selecting active versus passive, or even what you should look for in an active fund, let's say? What's your thoughts on that?
Yeah, and I know we have a, we're cognizant of the tax loss or the tax ramifications of some of the portfolio turnover that we have. And while maybe many investors will think of that as a negative, you can also spin this as a positive, and you can actually use tax loss harvesting to your advantage. And there are products out there on the active management side that actually looks to harvest those losses. And if you do this over time, you can actually build up enough losses on those portfolios to more than offset the gains. And in a well-diversified portfolio, if you have some of these tax loss harvesting strategies in there, you can actually use that to offset the gains you're taking on other portions of your portfolio. So, I think a lot of people think of the taxable ramifications of portfolio turnover. That's only one side of the equation. There's also the other side, which is tax loss harvesting, which can be a very effective strategy. And I think that's something that also can differentiate active versus passive. And that, I think, is something that's very underappreciated.
Well, that idea of after-tax alpha, isn't that really what matters the most too, right? What do you get to keep out of everything?
Absolutely.
So
yep. What's in my wallet after it's all said and done? Yep.
Right. What I was going to say is related to that too, is in the role you actually do a lot of work in multi-asset portfolios and thinking about that, and those have to be actively managed on top of active management on that. What would some of the thinking that you apply to that? How can advisors apply that to their clients' portfolios as well? What should they be thinking about holistically around portfolios?
Yeah, it's certainly, I think the key there is holistically. It's easy to think of things on a line-by-line basis, but as we just said, what matters most is what you end up in your wallet, right? That's the money you're keeping. And, while most people will sort of look line by line, when you aggregate it all together, how does that all work together? And that, I think, is the biggest component that might get lost in the shuffle. It's easy for individual investors, your clients, for example, to look line by line, but when you sort of redirect the focus, what's the big picture number? Yeah, you may have a couple of losses on a few individual line items, but those are not working now. They may be working in the future. There's a reason why all of this is put together. And it comes back down to, at the end of the day, it's the holistic view. It's the portfolio performance with the risk-adjusted returns and the after-tax alpha. All that together is, I think, the biggest component that matters the most.
So, I mean, the theme of today is having an active strategy for recovery in here. And it sounds to me, when I take it away, it is thinking about where the opportunity is and being able to position where that might come from. And that's being attuned to the rotations that are out there and where the growth opportunities are coming in. It comes down to also watching the risk exposure that you have around that, and how do you manage around that as well. And to me, the third thing that really does come to mind is looking holistically at the portfolio, how those pieces really need to fit together to be successful on this stuff. And if I summarize it in those thoughts, I would just ask one last thing, Jack. What's your final advice? What's the final thing people should take away from this?
I think there are a lot of opportunities to take advantage of market timing, or not market timing, but market structural shifts. And I think you're going to get to that point only via active management. It's very difficult to get through these things on the passive side. And what you walk through, Dave, those things are the ones that matter the most, right? You're getting into places where maybe the market is providing opportunity. You don't get that on the passive side. You have a chance to risk management. You're not getting that on the passive side. You have chances to tax loss harvest. You're not going to get that on the passive side. So putting it all together, again, you get for what you pay. I think there's a lot of things that come to the table with active, and especially if we think about sort of the regimes that we've been in, it's sort of been a one-shot deal, right? Rates have gone one direction for the last 10 years. We haven't seen the Fed really do much. Those are probably going to change a bit going forward, and that's where you're going to start to see volatility come back into the market. We'll see how that passive shakes out when we get these regime shifts going forward, and I think that's where you're going to start to see the things we just talked about really shine on the active side. That's where it really comes to the forefront.
And there you have it. I mean, that's the whole crux of this thing. Everything's beginning to change, and this opportunity is there, and investors have this pent-up demand. And I think the challenge is going to be getting them effectively positioned for it, both on the up and the down, and being there again, because it does feel different. But with that, let's wrap it up. Jack, I really want to thank you for the time on this. It's always interesting, always informative. I always learn something when we do these conversations. And I'd like to thank the Actors Managers Council and the Investment Advisors Association. Really appreciate the partnership and working with you guys. And then what I'd say to everybody on the line is I'd encourage you to really go take a look at the Active Managers Council's reports. Go to activemanagers.com. Not only do they have kind of the insights you need on active management, but they'll have some really effective proof points for your discussions with clients on this. So go there and see the full offering. And with that, I'd like to thank everyone for joining us today. Thank you.